We're all looking for the next big winners in the stock market, and the tech sector has consistently produced some of the hottest and, more importantly, most profitable names over the last 2 decades. But how can investors find the true market leaders in this ever-evolving space? Well, here with me today to talk about all that is analyst Mark Mahaney. He's the head of internet research at Evercore and author of the new book, Nothing But Net, which outlines investing lessons gained from more than 2 decades of experience covering the tech and internet sectors. And Mark, we're so excited to have you here this morning. And can you talk a little bit about your approach to the tech and internet sectors? What makes it so different when evaluating stocks in other areas?
The single biggest reason why I wrote this book is I thought that over the last really 25 years of looking at tech stocks, consumer tech stocks, particularly internet stocks, I'd seen a mistake that I thought was consistently made, which is that people were looking at trading around these names rather than investing in the highest quality names in there. And I look back at what tech, and you mentioned this earlier, Alexis, as part of the setup, and what consumer internet has been able to do. It's been able to generate phenomenal returns, not in a short period of time, although that's happened, but over an expansive period of time. And there are a couple of numbers that just stuck out to me. There's an acronym called FANG that's really well established now. But if you step back, that includes Facebook that's up 600% since its IPO, and Google that's up over 3,000%, Netflix up over 45,000%, and Amazon up over 160,000%. Like, those are real numbers. And my thought was there's got to be some lessons in that. Also, those are just the successes. Now, there are plenty of big failures in there, but there are lessons if you look at tech stocks. That's what I really tried to pull together in this book. Tech stocks also, people tend to want to trade them more because they can consider them to be highly volatile. I think that's probably true. They are highly volatile. That doesn't make them uninvestable, though. And sometimes people stay away from tech stocks because of the high multiples. And I try to spend a fair amount of time explaining how you can look at valuation in a growth sector, and even in a sector where you don't have earnings, you don't currently have free cash flow. Because I've seen some of these stocks do phenomenally well in environments where they aren't currently generating earnings.
So what are you keen off of? I know you mentioned revenues. Is that maybe a better fundamental aspect to look at when some of these companies haven't really showed consistent earnings?
Well, at least I'll point to a few examples where the public markets have clearly been willing to prioritize over long stretches of time revenue and lead customer metrics over earnings or free cash flow. I think Netflix is a wonderful example of this. Netflix was the single best performing S&P 500 stock last decade. In other words, between 2010 and 2019, the stock soared about 2,000%, handily beat the market. And it wasn't because of earnings or free cash flow. In fact, as I go into detail in the book about this, free cash flow burn actually worsened every year, almost every year throughout the decade. They went from losing $200 million in free cash flow to, by the end of the decade, they were burning $3.2 billion free cash flow a year. So there's a huge disconnect between the profitability of the business and the performance of the stock. It could be that the market was irrational for a decade, but I think that's a hard call to make. Instead, what the market did was it focused on the fact that the company was able to generate consistent premium revenue growth north of 20% and really at 30% growth for multiple years, despite increasing scale of the business. And the company was able to show accelerating sub adds, the number of new subscribers that they added. So for me, the lesson is the market will focus on what are called lead indicators. Revenue is a lead indicator. I know there are companies that generate revenue that never generate any free cash flow. But there are no companies that generate free cash flow that don't first generate revenue. It's a simple point, but I think it's an important one. And I think one of the things I learned from covering tech stocks over these years is usually scale wins for a variety of reasons. But you get enough scale. Most business models, if you give them enough scale, they'll generate profits for you. Even businesses like Amazon that are in what are intrinsically low margin, reasonably capital intensive businesses. Scale wins most of the time. So to me, that was the lesson. If that's true, if scale does lead to profits, then you want to look for companies that can tap into scale, that can become really large companies.
what should investors be looking to separate out some of, the popular, buzzy names from what's actually being profitable?
And Alexis, you're asking the right question. And I go through history and I try to draw lessons from the wonderful winners, but there are also lessons from the amazing losers. I think in that camp would be names like AOL Time Warner, which is considered the Google of its day, the Amazon of its day, if you will. eBay is a wonderful example, and Yahoo too. So, for every Amazon, there's an eBay. For every Google, there's a Yahoo, and there are lessons between these. And I think there's at least two things I would highlight. I go through 4 or 5 tells of what I consider to be a really high quality company. And one of those tells is the power of the value proposition. So the simple way I phrased it is follow the value prop, not the money. That's the tagline I use, follow the value prop, not the money, i.e. you want to look for companies that have really compelling consumer value propositions, not necessarily ones with the great business models. Amazon and eBay is a wonderful example of that. Grubhub and DoorDash is another wonderful example of that. Amazon is the king of online retail today, but that wasn't the case for the first decade of the internet. That was eBay, but eBay at one point had 6 times the market cap of Amazon. It now carries a market cap that's 1/50th the size of Amazon. And even if you strip out AWS, it's still a dramatic discount. And that's because whereas eBay had the better business model and portfolio managers loved eBay, and it was a great stock for the first 5 years as a public company, the fact that they ran their margins up and they tried to focus on sellers rather than consumers created an enormous opportunity for Amazon, which Amazon capitalized on. Amazon focused, even though the business model was way inferior to eBay at the time, they focused on price, selection, and convenience. And over time, more sellers and more buyers came over to Amazon, and that created the scale for the business. It became a much larger business, and therefore, and eventually, much more profitable than eBay. So I really focus on, and investors can do this too, like focus on the asset in the space that you think offers the most compelling value proposition, not the most profitable business, because I think consumer-centric companies in the long term usually beat investor-centric companies.
Mark, if you're someone that feels like you missed out on getting in on one of these big names like Amazon as it was getting going, what can you look for to get in on the next secular growth style? And, do you think that tech growth has hit its peak? I mean, it's been bullish now for so long.
Yeah, and tech growth, Alexis, covers so many different things. I will make the simple point that at the end of the day, there's one idea I try to get across in the book. The single most important idea is hunt for DHQs. So not DQ, that's Dairy Queen, but DHQs, dislocated high quality companies. So I try to describe what I think are high quality companies based on the lessons I got from 25 years of covering internet stocks. Dislocated stocks, those are the ones that have traded off 20 or 30% or are trading at a discount to their growth rate, i.e. technically an expression called a PEG, less than 1, price to earnings to growth multiple less than 1. But you can even use a simpler rule of thumb, which is a dislocated stock. And even the highest quality stocks have become dislocated. I go through that in the book. You've had plenty of opportunities over the last even 3 years to buy Amazon, Netflix, Google, Facebook, and other high quality names that are trading off 20 to 30%, even 40% from recent peaks. Facebook gave you a wonderful opportunity to do that in 2018. So my approach is, just because you didn't get the last investment opportunity doesn't mean it's gone. Chances are in the next couple of years, the highest quality names that you can identify, and I think in consumer internet, they are names like Amazon and Google. They're probably going to dislocate either as part of a market rollover. There's always the inevitable missed quarter. There's always some execution issue. But if they're truly high quality, the companies usually solve those problems and you make money buying them on those dislocations. So that's the concept in the book.
Are you seeing any names right now that would fit that criteria?
Yeah, there's a few. Right now, you've got a trade-off in Facebook. Facebook's off about 15, 16%. This is the 3rd time in 4 years that Facebook's at the center of controversy. In 2018, there was a Cambridge Analytica scandal. And in 2020, there was a political boycott. It's relatively small scale, but they certainly received a lot of headlines. Political boycott, advertising boycott of Facebook. And then this year, in the wake of the Facebook Files expose, you see a smaller correction. And I think in a way, the public markets, although there are significant ESG concerns about Facebook, I don't want to minimize those, but the stock has been tested, and investors realize that if you get a chance, that Facebook's business model is very high quality, its growth profile is high quality. And so if you get a chance, when that thing gets dislocated, you'll find a lot of buyers for that. But anyway, I think Facebook comes close to being dislocated off about 15%. Uber is another one that I think has been dislocated. And if I want to go out a little bit, I'd argue a name like Spotify. Whether that's proven high quality or not, I'm not sure. It's getting close to being what I consider to be a truly high quality company based on its market opportunity, its management team. That stock is clearly dislocated. So that stock is up off as much as 40% from its earlier in the year highs. So yeah, there's a few examples.
Well, Mark, thank you so much for your insights today. We really appreciate it.
Thank you, Alexis.
And you can head on over to investors.com for more of our tech sector coverage. For Investors Business Daily, I'm Alexis Garcia.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.